Here are three investment trusts have recently drawn attention for their strong long-term performance and potential to achieve an average return of about 13.7% annually. These trusts have demonstrated consistent growth over the past decade and remain attractive options for investors looking for high potential returns. The reason this target is seen as realistic is that these trusts have already achieved similar rates of return in previous years. Industry data also shows that investment trusts trading at discounts to their net asset values often perform well in the following years. Historically, investment trusts have also beaten cash savings over most 10-year periods, which strengthens the case for long-term investment. The first trust highlighted is Allianz Technology Trust. It focuses on global technology companies, including those involved in artificial intelligence, software, hardware, and digital services. The trust has achieved close to 10% annual growth since 2015 and continues to benefit from the rise of technology and digital transformation. However, investors should be aware that technology valuations remain high, making the sector prone to pullbacks during market corrections. The second trust is HG Capital Trust. It invests primarily in private companies within the software, financial, and service sectors. This private equity style of investment has produced strong returns of more than 16% annually in recent years. Because it focuses on unlisted businesses, the trust carries higher risk and less liquidity, meaning values may fluctuate more sharply during downturns. The third trust is JP Morgan American Investment Trust. This trust gives exposure to large U.S. companies across technology, healthcare, finance, and consumer sectors. It has delivered more than 15% average annual return since 2015 and continues to benefit from the long-term strength of the U.S. market. Still, high valuations and exchange rate movements between the dollar and the pound could affect returns for UK investors. Investors interested in these trusts should consider their long-term goals and tolerance for risk. Returns above 13% are more likely over a period of 5 to 10 years rather than 1 or 2. A blend of these trusts can help balance risk and reward. Those seeking steady growth might combine a broad U.S. equity trust with a technology-focused one, while more adventurous investors could add a private equity trust like HG Capital for higher upside potential. Buying investment trusts when they trade below their asset value can further enhance returns, and UK investors may find it beneficial to hold such investments within a stocks and shares ISA or pension account for tax efficiency. Although past performance is encouraging, it does not guarantee future results. These trusts depend on market conditions, sector growth, and the skill of their managers. The 13.7% figure should be viewed as a target rather than a promise. Anyone considering them should be comfortable with market volatility and the possibility of temporary declines in value. In summary, Allianz Technology Trust, HG Capital Trust, and JP Morgan American Investment Trust are three well-managed options that have shown strong historical performance and remain positioned for potential double-digit returns. Long-term investors willing to accept the risks may find them worth further research and consideration.